What's up guys, Nick here, back with another video. Today we are taking a look at the cruise lines. Is now the time to invest? I'm a self-taught stock investor and I found it annoying how much awful advice there is out there, so I decided to make videos to show people the right way how to do things and stop losing money. I went through all the financial information for these companies and I found some pretty interesting stuff that you're going to want to know if you're considering investing. At the end, I'll also give you my personal recommendation. Let's take a look. A lot of people say that the best time to buy a stock is when the price is way down. Well, right now, all three of the major cruise companies are down about 70% over the past 6 months. So we need to figure out if this is an appropriate drop or if this is a complete overreaction. The first thing we need to take a look at is how are these companies performing before the COVID crisis. So here's the revenue for Carnival, Royal Caribbean, and Norwegian from 2010 to 2019. What we can see is Norwegian was the biggest grower during the time period. Royal Caribbean had steady growth and Carnival was a little slow for the first half of the decade, but picked up a lot in 2016. All of their operating margins averaged around 15%, which is a pretty good number. They also showed pretty steady net income growth that matched along with their revenue growth. So let's take a look at their balance sheet. This part's going to be a little odd because Royal Caribbean and Norwegian report their first quarter ending on a different date than Carnival does. But what we're going to be able to see is how Norwegian and Royal Caribbean were impacted in the first month of the pandemic. So let's take a look at how things changed for Royal Caribbean and Norwegian between December 31st and March 31st. So we can see at the end of 2019, both of these companies were in decent debt positions because they were both reporting their debt was about 100% of their equity. But we can see how things changed very quickly once we got to the end of March. Royal Caribbean was actually reporting that their debt was 162% of their equity in March, and Norwegian was reporting that they were 195% of their equity by March. So the most recent information we have from Carnival is they initially reported their debt at the end of November to be 45% of their equity, and at the end of February they reported their debt had only gone up to 60% of their equity. It's obvious that Carnival was in the best position debt-wise before the pandemic, but we have to wait and see how exactly it changed as they went through the second quarter. So if we look further into their balance sheet, we can actually figure out why they had to take out this debt. We can look at something called the current ratio. The current ratio is basically a comparison of their current assets, which is their on-hand cash and their income that they're about to receive, versus their debts that are coming up in the next year. For a person, this would be like taking somebody's income for the year plus all of their cash in their bank account and comparing it to all the bills that they have coming up throughout the year. And to be expected, all of these positions are not very good since they aren't sailing right now. In a normal situation, your current assets should be 200% of your current liabilities. We can see that all of these cruise lines are only able to cover between 25 to 60% of their current liabilities with current assets. But also keep in mind while you're looking at Carnival on this, that their reporting is from the end of February while the other two are reporting at the end of March. So we would expect this to get just a little bit worse over this time period. The last thing we need to take a look at is their cash flow statement. They all reported a positive change in cash over the time period, but if you look closer you can see that Royal Caribbean and Norwegian borrowed $4.7 and $1.9 billion in debt, and that's actually what gave them the positive cash flow. If you look at the free cash flow, you can actually see their capital expenditures, which are basically the costs they're paying for all their physical assets like their boats and docks, are already exceeding the cash that they're bringing in from the business. So what's clear about this is obviously not sailing ships and not taking in any revenue is really bad for their business. And things are quickly going to get worse if they don't start bringing in revenue. So the next thing I did was read through their annual reports. And these companies don't report information exactly the same way, so it can be a little bit difficult to compare perfectly. But what I found was about 50% of their revenue comes from North America itself. The other halves were split between Europe and Asia, but it wasn't as consistent on how much of their money was split between the two. Carnival had an interesting quote where they said that most of their bookings typically come several months in advance of the departure date, and typically the longer cruises are booked further in advance. They also said that 30% of their revenue comes from onboard services, so if they are able to hold on to your money, they still lose out on that onboard service revenue. Norwegian was actually the only one that had any information about the coronavirus in their annual report. This is probably because they filed their annual report last, so they had the best idea that this was going to be a big issue going forward. They said that the spread of COVID-19, particularly in North America, could exacerbate its effect on us. Any future wide-ranging health scares would also likely adversely affect our business, financial condition, and results of operations. So let's take a look at the current valuations that these companies are all trading at. I'm going to compare the current price to what they were earning in 2019 because they all reported big losses in the first quarter, so it can be a little bit difficult to tell what exactly we're looking at. So we can actually see that all of these companies are trading between 4 to 5 times their earnings for 2019. All of these valuations are very cheap if things were to return to normal immediately. Right now in July of 2020, the analysts are projecting huge losses for all of these companies all the way out until 2021. And if the pandemic situation in North America only continues to get worse, problems are going to get even bigger. You have to decide though for yourself if you think this risk is worth it. It could take a couple years before things go back to normal, but there's huge potential upside for gains, probably up to double their share price from where they are right now. Personally, I am avoiding buying any shares of these cruise lines, which is different from what I said back from when this pandemic started. When the stocks for these companies had initially dropped, I actually had bought some stocks in the cruise lines, but I ended up selling them after making about 10% because I didn't feel comfortable continuing to hold them, not knowing how the situation was going to resolve, and even what normal would look like once things get back to normal. Until people feel like they can actually go get on a cruise and they don't have to worry about getting sick or getting stuck at a port for months in quarantine, people probably aren't going to be rushing back in, even if they're booking cruises. Most of the companies have pretty liberal cancellation policies, so just because bookings are up, that doesn't necessarily mean that there's guaranteed cash coming in the near future. They also have continued to extend when they're going to be able to start sailing. We don't necessarily know how far they're going to have to continue extending until things get good enough where they can start sailing again. I could be completely wrong by passing up this opportunity and maybe everything goes away in a couple months and we get back to normal by the beginning of next year and these cruise lines are making tons of money again. I just don't feel comfortable taking on that type of risk when I know there's better opportunities out there for me to buy and make money off of. One of my favorite Warren Buffett quotes is that there's no called strikes in the stock market. That basically means that you can stand there at the batter's box and watch pitch after pitch after pitch go by and you don't have to worry about any negative impacts. Don't lose money. If you made it this far and you enjoy this content, please take a second to scroll down and hit the like button for me. It really helps me out so I can keep making videos for you. Also, one last disclosure, I don't currently have any positions in any of the cruise line companies talked about in this video, and I don't plan to open any positions with any of the cruise lines anytime soon. Thanks for watching.